Thank you, Mr. Chairman, and thank you, Chairman Bair, for your service to our country during what was certainly a very challenging time for our nation. And I'm sure you're looking for an opportunity to enjoy the life thereafter. But again, thank you for your service. There are so many aspects of the impact of what we've tried to do in response to the many problems that occurred. But I see it back through the eyes of many of the people in my district who are facing issues locally. And I was intrigued by your comment that many of the smaller banks are the ones that are competing now at a disadvantage because of the rules that have been focused on the large banks. And I hear a lot in my community, particularly in the housing sector, home builders, realtors, bankers. And there seems to be a game in which they're all sort of pointing to the other one and saying they're the ones that are responsible for not allowing us to get going. And everything that I have studied certainly indicates that a robust housing market is a key to getting out of an economic slump. Obviously, with such an amount of underwater mortgages, we're not going to see robust. But I also see small community bankers with responsible institutions who have weathered this area very well, and builders with very good reputations who have proven their capacity to analyze the market. And right now, some are actually looking and saying, now's a great time to take risk if you understand your market. And yet, what I'm understanding from talking and meeting with my home builders is that many of them are up against what they are concerned about as hard caps for construction lending and development lending. And what I really need to understand is whether or not this 100% hard cap is really that. Is it advisory, or are we creating the kind of hardline standard that locks in the inability for local bankers and local builders to do what they've been doing for generations, which is to make sound judgments about each other?
Right. Well, I think construction and development lending is very high-risk lending. And if you look at the failures we've had for the smaller institutions, they've been almost heavily driven by losses in construction and development lending and high concentrations of those. So, yes, it's a benchmark. It's not a cap. But the general rule is 100%. Those shouldn't go over 100% of capital. And if they do go over 100% of capital, you need to have special risk management processes in place and board-level involvement in managing those risks. So there is a lot of scrutiny of C&D lending. It's not a hard cap, but I would say there is a lot of scrutiny of it, and well justified given the number of banks we have seen that have failed because of heavy concentrations in that area. And again, it depends on the local market, but obviously in some areas they're heavily overbuilt already. And so it's probably the last thing you need is to start a new housing tract. But that is based on local conditions, and our examiners are asked to look at the local conditions.
Well, they are. They are taking into factor not only local conditions, but the history of both the builder and the institution. Well, obviously, they don't analyze the builder, but they're living through the builder's living through the analysis by the bankers.
Right.
Well, I'm hoping that that's an issue that can continue to be analyzed on the local level, and that the regulators will take into consideration that impact. The other issue, which we're getting a lot, of course, from the realtors, and I know you've made comments on the QRM, and some of them have included even you're not quite sure whether we ought not let, if I'm correct, the incentives deal with it rather than this hard and fast rule. Can you give me your instincts on that and where we should be going with it?
I guess I am a market-oriented person, and so if we can let economic incentives drive lending standards instead of regulators micromanaging and saying this is what your lending standards should be, I prefer that approach. And so I think it's very difficult. I think the securitization process got completely out of control. It was a huge driver of the crisis. It needs to be reformed. And my sense is that meaningful risk retention, skin in the game, will be the best way that we can discipline underwriting standards going forward. I would like to bring the securitization market back. I think it's a healthy part. I would like to have banks have diversification in their funding of their lending activity, but it needs to be brought back in the right way. And already we're getting into debates. I think the staff put together what they felt objectively based on a lot of analytical work were the quote-unquote gold standard, which was the directive of the legislation. The QRM was meant to be an exception, not a rule. But now we've got into arguments about, are we setting the standards too high? Is this going to disadvantage people? And yes, my preference would be that just everybody has to keep some skin in the game to discipline it that way, as opposed to, again, regulators trying to micromanage what those lending standards should be. I think I can say that freely because I won't be part of the decision-making, as you know, but that would be my preference. That plus, and I also agree, I think Chairman McHenry has spoken to this, we need loan-level disclosure in these securitizations. For investors buying these mortgage-backed securities, need to see the loans inside these securitizations before they make an investment decision. That would also be a very good check on underwriting standards.
Well, your perspective is very important to us as we look at these policies, and thank you again for your service. Mr. Chairman, I yield back.